Good morning again. How we doing? Last panel before lunch. Always a good spot to be in. So thanks, Jim. As he mentioned, I'm Steve Sachs. I'm Global COO of Goldman Sachs ETF Accelerator. I have figured out that is a very fancy word for cat herder. And it's not necessarily a real job. But ETF Accelerator is a platform that Goldman has built over the last couple of years to help our clients launch, list, and manage their own ETFs and just do it faster and cheaper than they can do it on their own. And this whole idea for this business at Goldman really came out of active ETFs and our institutional clients, asset managers, hedge funds, family offices, calling up and asking for what was the roadmap in which to take their strategy, active largely, and get it into the market in an ETF wrapper. So thus a business and an idea was born. So I think, obviously the topic here today is super interesting, I think, for everybody here. So I'm actually going to let each of the panelists introduce themselves so I don't mess up any particular details. But maybe, Bruce, starting with you.
Sure. Everybody hear me? Great. So Bruce Saltzman, I work at State Street Global Advisors and am responsible for ETF capital markets. I have been at State Street for almost 11 years and beforehand worked on the sell side for about 8 years. So in ETFs for, I know the math doesn't actually add up, but in the ETF industry for 18.
Hi, I'm Matt Tuttle, Tuttle Capital Management. We've got 12 ETFs currently, another ton in different stages of filing, about 850 million in AUM, depending on NVIDIA's earnings tonight. Typically, we're known for trading vehicles, but that's particularly because I've got an affinity for self-directed guys who figured out they can do things better themselves. And 99.9% of the active ideas that come across my desk suck. We do run 2 active funds, Brendan Wood Top Gun, because his process is insane and can't be repeated, and Laffer Tangler Equity Income, because Nancy Tangler's one of the only talking heads out there that's not an idiot.
Hard to follow that. So for those of you who are looking at the agenda and a little bit confused, I confirm I am not Rafael Zayas. Rafael, unfortunately, had to step out for a family emergency, so I am stepping in. For those of you who know Rafael, you know that he is not easy to replace, but I will do my best, and thank you all for your patience with me. My name is Amrita Nandakumar. I am president of Vidant Asset Management. We are a platform for investment ideas. We help design strategies, or we take strategies that prospective issuers bring to us, and we can bring them to life, whether it's an ETF wrapper, SMA, mutual fund, or something else. The firm's been around for a little over 10 years. We just celebrated, actually coming up on our 11th anniversary. Wow, time flies. So we currently work with 28 different ETF issuers, and we have just over 10 billion in assets under management.
Good morning, everyone. My name is Mike Eschman. I work at Rex Financial. I head up business development at Rex. My role is sort of bifurcated into ETF capital markets and sales. I've been in the ETF industry since 07-ish, thereabouts. I've been at Rex for just about 2 years. And Rex, we manage 3 separate lineups of ETFs. We partner with the Bank of Montreal on a suite of leverage and inverse ETNs. We partner with this guy over here for T-Rex, 2X single stock ETFs. All those are designed for the active trader. And then we also recently sort of got into the more buy and hold type strategies in covered call. This is an active panel. It's an active ETF, a covered call strategy designed for the income investor.
Excellent. Couple of ground rules for this panel, and then I'm going to kick it off with some stats around the active ETF landscape before we dive into the discussion. So during our prep a week or so ago, and Many people in this room know that I am notoriously a non-prepper for any of these things. We decided to have a bit of a free-for-all. One, it's right before lunch, so we actually decided that we're not going to direct any question to any individual at the panel. Everybody gets to answer everything and dive in wherever they want. And then two, instead of holding questions to the end, we want this to be a dialogue with all of you. So raise your hand, shout out a question. They were going to attempt to pass out microphones. We're not even going to do that. Raise your hand, shout out questions. One rule there, I will not call on anybody that is either a current or former colleague of mine at Goldman Sachs. Yes, Christian, that's for you. So let's get started. So active ETF world. Look, everybody reads the headlines, and I think over the last couple of years in particular, when you think about what has happened in the ETF space, it has largely been about active. There's been a couple of great panels this morning already around the regulatory side. Obviously something that I think will weave into our conversations here as well, share class and the like. But just to set the stage, year to date, it's only May. We've got $97 billion in inflows into active ETFs. There was $130 billion last year, so think about the pace that we're on. Last 3 years, $353 billion has flown into active ETFs. 3 of the last 4 years, 70% of all ETFs launched have been active. One of those years, last year, I believe was a record year, right? Over 500 ETFs launched, 70+% of those were active. You can't deny the data. The data is real, the flow is real. It's not individual niche products, it's a wide range of products when you think about some of the flows, and we'll get into this a little bit later, but it's been big river asset classes as well. So with that as our jumping off point, let's start with the evolution. Would be interested to get everybody's thoughts on a little history. Somebody give us a history lesson as to how did we get here with active ETFs and where we're at right now.
Well, it dawned on me, Steve, as we were talking about this, about 5 years ago when we were all sitting here, the great debate was on which semi-transparent model was going to win the day. Is it going to be the Presidium model? Is it going to be the NYSE? That debate has not aged real well. We've seen sort of a migration away from that. I think perhaps that was an impetus to pull some of the big active managers into the space. But I think it's sort of evolved since then. As they've come into the ETF space, they've become more comfortable with the wrapper, with the ecosystem, and those sort of semi-transparent, non-transparent type strategies are pretty much gone away. As they became more comfortable with the wrapper, front running, the theft of IP became less of a concern. Obviously, assets were flowing into the transparent ETFs, and you're starting to see all of these mutual fund active managers sort of diving in with both feet now, and that whole debate, I think, is largely gone.
I would just add very quickly. Sorry, Matt. I don't have I don't know the full history of active ETFs. But if we just go back to the ETF rule 6011 that I think was introduced into the market in September of 19 and then implemented about a year later, that was kind of the impetus and the catalyst for everything that we've seen now. The ETF rule allowed for the standardization of the exemptive process. And it also allowed for active managers, asset managers, right, to utilize the in-kind mechanism for ETFs. And I think that alone, you just look at what's happened in the market since the ETF rule was implemented, and the new active managers that have entered the space, not just new products across all asset classes, right, but also the new asset managers across various asset classes, and it's been astronomical as you outlined earlier, Steve. So I think the ETF rule was kind of the starting point and inflection point for what we've seen or what we see now. And there's other things as well. I want to give everybody an opportunity to speak up, but there are other sort of catalysts that I think have led to where we are now, and the fact that 70% of new ETF launches year to date, or 69% year to date, have been active ETFs. That's outstanding. That's incredible. So I'll stop there, maybe.
Yeah, and speaking of catalysts, I mean, there's only so many indexes you can come up with. This morning, somebody just hit me up with an index that screens companies based on whether or not they hire convicted felons and whether they deal with private prisons. If anyone's interested, I'll find it in my trash folder. Active, unlimited with what you can come up with. You can charge more for active, obviously. I think people realize that standard asset allocation, indexing 60-40 is problematic. Mediocre at best, I would say. And if you can find active products to make that less mediocre, that's important. And I think Kathy opened up the doors for making active ETFs cool. Also highlighted some issues with how the media reports on funds and people do due diligence, but she opened up the floodgates, and hopefully we'll see, unlike the mutual fund realm where most of the active was really, index huggers, you'll see more and more good ideas out there.
Also, Kathy Woods was an answer on Jeopardy the other night. I don't know if anyone was watching. That's when you know you made it.
Yeah. But what about from the Biden view? I'd be interested.
Yeah, I think it's hard to overstate the point that Bruce made about 60-11, really lowering the barriers to entry, leveling the playing field, and making it such that the largest active managers from JP Morgan and that group all the way down to a shop that's running $1 billion in SMAs, that they can actually say, should we be thinking about this, right? Alongside of that, you've got an increased interest in the ETF wrapper from financial advisors and other intermediaries. And so you've got this great tailwind for managers to say, all right, maybe we really need to think about this. So yes, the numbers don't lie, agreed. But it's interesting to see the types of people that are bringing active ETFs to market, and more importantly, why they're doing it, right? The reason that managers should be doing it is because the ETF wrapper or the ability to market as an ETF is an important part of their fundraising strategy, right? Their distribution strategy. So we do see that. And so for managers that already are doing mutual funds or SMAs, to add the ETF wrapper to the tools that they have at their disposal for launching new strategies is an asset. You also do have folks that are saying, well, everyone else has an ETF, so maybe I should do it too. And so, we are seeing some of that as well. And then finally, we're seeing the folks that are saying, well, I would love to have an ETF. It's an ETF with my name on it, my firm's name on it. And so those are what I call the vanity projects. And so we do try to stay away from those. So for us, we really like to ask a lot of questions about the reason that firms are choosing to launch an ETF in an active wrapper, or an active ETF in an ETF wrapper.
Yeah, it's interesting. Somebody said to me recently that the opportunity to market a mutual fund is only diminishing and the opportunity to market an ETF is only increasing. And I quote that directly from a much smarter person than I, than said it. And I think when you think about, the line of sight that we at ETF Accelerator have to the number of clients in our pipeline and the reason that they're doing this, you touched on all of the reasons. It still begs the question, why now? 60-11 certainly obviously lowered the barrier, made it easier to launch an ETF. Didn't make it easier. I don't think anybody on the stage would tell you that it's still an easy process. Is it just a confluence of all of the events? And then this is a little off script, but now I have to beg the question, what are demographics playing into this? What's the next generation of wealth in that investor? Somebody touched on an earlier panel. Is that a catalyst? Is it, and where does it rank in the number of catalysts for the drive right now?
Yeah, I mean, one of the catalysts, I think I've spoken to several large mutual fund companies who got into ETFs recently. Wirehouse demand is one of the main reasons. They had expressed that they were reluctant to get into ETFs because they were afraid of upsetting the agreements that were in place with the wirehouses. Some of the revenue share agreements, and it wasn't until the wirehouses came to them and said, "Hey, our clients are interested in your strategies via an ETF," that they got the confidence and the green light to go ahead with that. I know that was a big catalyst for several of the larger mutual fund companies out there.
I think another is if we just take a step back and look at the market and what we've seen over the last few years. I mean, you take a look across all asset classes, and there's more sort of dispersion of returns than there has been if you go back to after the financial crisis, when we've seen year over year kind of increases in assets under management, significant sort of growth in indexing. So I think a little of this has to do with now is the time for active. We're in an inflationary environment. Interest rates are higher. You've got monetary policy, Fed policy, and this uncertainty around the world. And you can see, I mean, we don't need to outline it now, the dispersion that we're seeing in returns across asset classes is really meaningful. So, active, I think for many clients, there's more demand for that active strategy, and I think that plays a huge part as well.
And in just kind of touching on that, I mean, markets have changed since COVID. If anyone was around in the late 90s, which I was, individual investors were really interested in individual names. And that's happening again. It's happening differently. You have, and it's under the radar screen, but it's the group that we deal with on a daily basis. You've got a massive group of retail investors all day, every day, talking about stocks on Twitter, on Discords, on Reddit, on all sorts of different platforms. People are interested in stocks, unlike anything since the internet bubble. And, and I'll go back to Kathy, because I think Kathy was a trailblazer in playing to that, where, when she put out her trades every day, that was a must read. Now it's a must read because it's your short list, but it was the long list back in the day, and people were just interested in that. That was a lot of fun. People were talking about it. I think, S&P 5, SPY and Ag, I don't know that you're going to get away with that anymore. I think there is much more demand for active, and that's a big part of it.
And for why the ETF wrapper, and I wonder if this is what you were alluding to, let's think about the fact that there's a massive transfer of wealth that's going to be taking place, or is starting to take place, from the baby boomer generation to Gen X and to the millennial generations, all of which those two have expressed a great level of comfort with the ETF wrapper, right? For them, they're seeking out the best strategies, the best performing strategies, the best exposure that they can get. And if it's an ETF wrapper, great. If it's a mutual fund wrapper, that's fine too. And so I think this level of discomfort with the ETF wrapper that took some time to work through, I think that is, again, another tailwind to why we're seeing so much in terms of active.
Yeah, and to that point, I just read something in Pension and Investments about a survey done where 80% of the investors surveyed would choose an ETF, an active ETF, over a mutual fund going forward. So I think that migration has already begun.
Yeah,
The
actually.
flows,
Go ahead.
sorry, just real quick.
Yeah.
Okay, Steve, the flows, adding on to that and sort of driving the point home, the flows, I read this morning, the flows that we've seen in actively managed mutual funds over the last 5 years since the inception of the ETF rule, we've seen about $1.8 trillion in outflows. And over that same time period, we've seen $380 billion of inflows into active ETFs. And so it just speaks volumes. And I thought that was, I wanted to add that.
No,
just to
because it's
drive the
actually,
point home a little bit more.
Bruce, you've just done a beautiful segue really into our next question, which is sort of, right, where did we start? A little bit of the history, where are we now? And I threw out a couple of stats, and that's a great one in particular, Bruce, when you think about the differential between fund flows or fund structure flows between ETFs and mutual funds. But now a couple of other things I'll throw at you to seed this next question. 55 new active ETF issuers last year alone. 18 of those had existing mutual fund franchises. So obviously we talked about the share class on the previous panel. Interesting stat that someone on my team gave me, I didn't even realize this, 40% of all active ETFs have greater than $100 million in assets. And when you think about that magic number that people ask, what makes an ETF viable from an AUM perspective? And by the way, I think that's come down, over the last decade. But if you've got $100 million, in AUM in an ETF, you're doing okay relative to the universe out there. And last thing before I sort of, turn it to you guys and ask the question, just last year alone, when you look at the flows into active ETFs, the 4 major categories, starting from the top, were large blend, equity income, option strategy, but they're equity income strategies, large value, large growth. Those are the top 4. Those are big river asset classes. These are not niche-y products that are coming to market. So that just, again, begs the question, where are we now? What's next from each of your seats? What are you seeing? And maybe more importantly, what are you not seeing yet you think we will see?
The 100 million number is interesting, and I'd like to think that it's because those of us in the ETF industry have done a good job of educating prospective issuers that you really do want to come to market with a little bit of scale, right? Not only do you need a sound distribution and marketing plan, but the more assets you can start off with, the better off you'll be, especially in the early days. So, and of course I just lost my point. With active, I think one of the things that we find with prospective issuers is they think about how they want to bring their product to market, right? So there's 3 paths. You could do a conversion from an SMA or a mutual fund. You can just do a clone strategy, meaning you take something that you're doing in an existing wrapper and just decide you want to duplicate it in an ETF wrapper, or you can just do something completely different, whether it's just an entirely new asset class, or maybe you're leveraging some research on the active side, and you want to be able to utilize that in a related but somewhat different strategy, kind of like a different flavor of toothpaste, let's say. And so we are finding that issuers are being more thoughtful about the path to launching an ETF, understanding that it really should be made on a case-by-case basis, and really thinking about how it's going to impact their distribution strategy.
So I'll tell you what I want to see, and it's not more large cap blend. Again, I think a lot of the traditional asset allocation strategies out there are mediocre. And my hope would be that active strategies would help enhance those in some way. Something different that's going to be less correlated. Managed futures, for example. Love the idea of tactical strategies. Unfortunately, most of them are awful. That's a real hard strategy to do, but if someone's able to pull it off, that's a great addition. Or, just different types of ideas that really add something to the portfolio that you don't have, because if you've got SPY, do you need an active large cap blend? I would argue not, but something that's different, something that's additive.
Yeah, Steve, I would just point out that, of those categories you mentioned, options-based strategies, income strategies based off of option strategies, buffer, covered call strategies, roughly $50 billion in assets in those products. That $50 billion has really just come in the past 2 years, 2.5 years. So It's sort of there's a lot of room for innovation there, and I think we're going to continue to see that particular category continue to grow as investors are looking for alternative sources of income.
Yeah, I mean, without a doubt, right? That's the flip side of the demographic trend that we talked about earlier. The next generation of wealth, that current generation of wealth wants income, right? And I think that's obviously been a big driver. And maybe the flip side of that question then, right? Because at the end of the day, this was asked on a panel earlier, and we talked about this in the prep, the big debate, if you will. What's not right for the ETF wrapper, active or passive? And what has evolved? Is that the same now as it was 5 or 10 years ago? And do you think it'll be the same now 5 or 10 years from now? But maybe start with, what do we think isn't right for the ETF wrapper? Bruce, I actually would like to start with you. I think you have a very unique lens on this, given where you sit.
It's a good question. I think what's not right for an ETF wrapper. So just thinking about the strategies, any strategy that will not result in a cheaper fee within an ETF wrapper that doesn't already exist, either a new strategy that does not already exist, or something unique that does not already exist within a mutual fund wrapper. That's the first. The second is if there's an opportunity, right, for scale and for that same strategy, right, to be offered within the ETF wrapper, fees. Although fees, I know we're going to get to this in a moment, are not, the highest priority for those investing in active ETFs. So it starts there, and then any strategy that's also not able to utilize the in-kind mechanism that allows for ETFs, right, to be so tax efficient. If you have an active strategy that does not allow for that, then you have to ask yourself as an asset manager and an ETF issuer, would this make more sense in another vehicle? So I think that's kind of the starting point. And then from there, we spend a lot of time right now looking at various asset classes and alternatives and active managers, and just understanding what might we be able to fit within the ETF wrapper where we think the value proposition for clients is a little bit greater than it is right now if that strategy also existed within a mutual fund.
Yeah. And Matt, I suspect you have a strong opinion on this particular topic.
Well, yeah, and I mean, we get hit up a lot for people who want to launch ETFs, and for us, it's illiquid stuff. We had someone who wanted to do a collectibles ETF, a structured product ETF. All the time I get hit up with ideas that are really, really cool, but the underlying is completely and totally illiquid, and just not going to work in an ETF wrapper.
I would echo illiquid. So, micro cap, low liquidity, hard to access names that, to your point, that are going to make the in-kind process a little bit more difficult to utilize. We also find that for folks that generate a lot of alpha through timing, that can often be an issue as well. And so we are approached by prospective issuers. They have a strategy that's highly based on timing, and they want to utilize the ETF because it's tax efficient. And then we share with them that one of the large tools at our disposal, namely the use of custom baskets, does require some time. It's usually a 2-day process. And so to the extent that there is a strategy that really is, hey, I need you to pull the trigger now. I don't care what price I get, just do it. We're finding that those strategies are really, it's kind of like square peg, round hole.
Yeah, and along the same lines, I mean, strategies that have capacity constraints, right? You don't have the ability to shut off new assets coming into an ETF, not without a lot of headaches. So certain strategies are not meant to be 10 or 50 billion in assets. Strategies along those lines are probably better suited for a fund than an ETF.
Yeah, we get the capacity one a lot, questions around that. I want to get to fees, but Bruce, you want to add
Just
something?
one so capacity I think makes, I absolutely agree with that. The liquidity is interesting, right? Because on one hand, absolutely, right? But if that strategy were also going to exist within a mutual fund wrapper, like sort of the same thing, and so therefore, from an ETF perspective, if you've got that additional layer of liquidity in the secondary market, everybody sort of knows that an ETF is only as liquid as its individual securities. If you had that secondary layer of liquidity where investors are able to buy and sell in the secondary market, then that could be additive as well. So just to play sort of devil's advocate on the liquidity piece,
Yeah.
Although you could go either way.
All I wanted Hempstead to say earlier was cost plus risk equals market. I think it's an important part of the conversation when you think about portfolio construction. I want to get to fees in 1 second because we want to end on that, and it's shocking to me that nobody's asking questions so far. So in a minute, I'm going to start calling on people. Unscripted question, because it's been talked about all throughout the morning. We just talked about it, the custom in-kind basket mechanism, the driver for growth of ETFs in the U.S. in particular. That's clear. There's two things, right? It's the tax efficiency relative to the mutual fund cousin, and also the demographics that we talked about. Bonus question: is paying out a capital gains distribution in an ETF still the third rail?
For the issuers that we talk to, absolutely. Especially if they know that we have tools at our disposal in an ETF that we don't with the mutual fund or an SMA, then absolutely. That's what they ask us. And so we do find ourselves having to caveat that, listen, we'll do our best and we'll definitely do better than you could probably do yourself. But hey, if it's a rising market, then we're all going to be spitting out gains. It is what it is.
Yeah, I would agree. I think there are certain strategies which are generally not tax efficient, and for instance, some of the trading vehicles that we represent. So in that case, it's less of a concern, but generally speaking for ETFs at large, yeah, it's still, I don't know if it's a third rail, but it's close to it.
I think it depends. I mean, if you've got, some large cap blend ETF that's the same as everything else and pays a big capital gain when everyone else doesn't, yeah, that's a problem. When you've got a unique exposure that's doing what it's supposed to do, I think that's a conversation you don't mind having with shareholders.
I would agree. Any conversation we have with an intermediary client, an institutional client, especially intermediary, they hate capital gains. And, so to your point, Matt, you want to avoid it if you can. You absolutely want to avoid it if you can. But, if you've got a strategy that is unique and is compelling, then you need to tell that story.
Yeah.
Or if you have a strategy that's wildly outperforming, then capital gains are just a champagne problem.
That's right.
It is why we all invest, isn't it? Capital gains. Last question before I start literally randomly calling on people in the audience. Again, we've touched on it a couple of times here, fees. And when you think about, right, what's the headlines that we've all read over the last and experienced over the last decade, the fee war in ETF. Is it over? Is it still going on? Is that an active versus passive thing? From all of your seats, what are you seeing and thinking about from a fee perspective?
Yeah, I mean, if you look at the active space, I read this morning. I think there's 325 billion of active AUM are in the cheapest quintile, 35 billion in the most expensive quintile. So lower fees are still winning that battle in the active space as it is now. But unlike in the passive space, there's more upward fee. There's more upward fee issues now. Some of these new active strategies, if they're offering the value, just like with anything, if they're offering enough value, if you're beating the market, whatever the case may be, you're going to pay up. You'll be willing to pay up for strategies and managers that are able to do that. So that upward fee pressure is not something we're used to in the ETF world, but it's there on the active space.
So I would say yes and no. So as a smaller issuer, I have no interest in engaging in fee wars. So, we try to avoid that. We look at very unique exposures, but the two active strategies we manage are extremely unique, but both have followings that are willing to pay more for access to a Brendan Wood or a Nancy Tangler. So I think, if you've got a situation where you have people locked and loaded, hey, I want that manager, I don't know it means as much, but if you just said, hey, I'm going to launch this active strategy and we're going to charge 2% for it, which I had someone come to me and want to do, and I had to talk him down from that, where he said, hey, it's going to be so great, people are going to pay 2%. I'm like, no, they're not. It's just stupid. So it just depends.
Yeah, I would agree. At State Street Global Advisors, we kind of utilize a slightly different model where, if we have the expertise in-house, then great. If we don't, then we'll go external and we'll find sort of the best in class for that strategy. And generally speaking, that strategy is not widely available for the intermediary segment. And so, there's a value prop there for intermediary and clients, which helps us, sort of sell the product. And those fees, that we charge there are generally, I would say somewhere in the middle. They're not the lowest cost, sort of core active. They're nowhere near the higher range of some of the other active strategies, but they're somewhere in the middle. And, it's our belief that we can charge, a little bit more so that the retail community has an opportunity, to access some of these managers and strategies that they might not have an opportunity to access otherwise. Yeah.
So it really seems like you can answer the question two ways, right? Whether you're talking about passive or active, and I'm sure, Bruce, you could speak to passive very much. I mean, there was a time, 10 years ago when that was all we talked about, right? And so if you argue that firms like Vanguard and BlackRock have really taken it all the way to the bottom, well, there's really nowhere left to go. With active, to your point, there's just such a diversity of managers, and especially if it's somebody that you're seeking for your portfolio, cost will probably not be your first consideration. In general, I would say it's more about the uniqueness of the exposure, the ability of the ETF to provide that, and then cost for some folks may be more of a consideration than others.
Yeah, without a doubt, and it's interesting. We talk a lot about active and passive. Like, there's a price for beta, there's a price for alpha. That's not the easy answer, but it's the easier answer. All of you have touched on bits and pieces of, again, what I personally think is the better one, access, right? And it's, Mike, to what your point was, is what we're actually seeing with active ETFs is fee expansion, not compression. There are certainly fee wars still going on, without a doubt, but we're not seeing that as much in the active space. We're actually seeing managers understand the alpha versus beta and the access question as well. So I think we're down to a couple of minutes. Questions? Can we get one question out of this crowd? We do have one. There we go. Sanjay, please.
How you doing? So obviously the ETF industry has cannibalized the mutual fund industry. Does the panel think that closed-end funds are next? Are you going to see, obviously GBTC converting, but are we going to see other closed-end funds? Are you seeing that trend starting now? Closed-end funds converting to ETFs?
I can tell you that from where I sit, I think the short answer to the question is yes. I think it's a longer runway. I think we're seeing signs of it, particularly when you think about some of the structural inefficiencies of closed-end funds. We're not seeing as much of that or have as much demand in our pipeline for that. And quite frankly, it also begs the question of why are we not seeing more mutual fund conversions as well? But anybody else on the closed-end fund?
On the closed-end funds, my guess would be you're not going to see that happen. The closed-end fund structure and the ability of them to often trade at large discounts means there is a horde of retail investors who love them. That the moment you take that and convert it to an ETF, you lose that person because you lose that advantage. So I don't see the point of doing that. could someone do it because they think, hey, I'm going to make more money by doing it? Yeah. But you've got a group of people who love their closed-end funds, love buying those things at discounts, that you're going to really piss off if you do that.
Additionally, you brought up a point about equity income ETFs. So I was wondering, how do you hedge a potential increase in volatility? Trying to fix it is basically the lowest in the last 4 or 5 years. Right? I mean, at some point, we're going to see a 20 bigs, maybe a 30 bigs. I'm not saying I'm predicting it, but at some point in the next 3 or 4 years, we're going to have an increase in volatility. How would you hedge against that income ETF?
See, in a covered call ETF, that actually helps.
Yeah, increase the premiums. So it really comes down to the strategy and what you're looking at. As Matt said, in covered call ETFs, an increase in volatility is going to increase the premiums and potentially add more income. Maybe buffer strategies, it'll affect those differently. So I really think it comes down to the strategy and the type of option overlays you're talking about.
With that, I think we're right on time. It is now lunchtime. I want to thank all of the panelists, especially you, for diving in so late. Thank you very much.